Since the crisis of 2008, two important and worrying trends have emerged that are having a powerful impact on the U.S. economy. First, before 2008, credit growth used to drive economic growth. Now, wealth creation plays the leading role in generating growth. Second, the annual increase in government debt makes up a much larger percentage of the annual increase in total debt than before 2008. This makes the economy and the financial markets much more dependent on government spending than in the past. This video will examine these trends and explain why neither of them bodes well for the future. It will also show why any disruptions to government borrowing or spending, such as those that could arise from the current budget negotiations in the Senate, could destabilize the economy and trigger a stock market crash. All the data in this presentation has been taken from the Fed's The Financial Accounts of the United States. Up until the crisis of 2008, credit growth was the main driver of economic growth in the U.S. And when credit growth was weak, the economy went into recession. Between 1952 and 2009, all 9 times that total credit, adjusted for inflation, grew by less than 2% a year, a recession followed, as shown in this chart. Total credit growth is shown in red, and GDP growth is shown in blue. Every time the red bar is less than 2%, there was a recession. That happened 9 times between 1952 and 2009. But since 2010, that pattern hasn't held. In most years, credit growth has been weak, but the economy has continued to grow. This anomaly was particularly noticeable during the last 3 years. Credit growth was particularly weak, but the GDP continued to grow by between 2.5% and 2.9% a year. Since 2009, a new driver of economic growth has emerged: surging wealth, shown in this chart. Household wealth grew to $169 trillion in 2024. It's increased by $108 trillion, or by 1.8 times since 2008. It's increased by $52 trillion, or 44% since 2019, and it increased $14 trillion last year, growing by 9%. This explosion of wealth is fueling consumption and economic growth. Household wealth increased by $11 trillion in 2023 and by $14 trillion in 2024. The problem with the economy being driven by wealth creation is that it makes the economy vulnerable to any significant wealth destruction. This is a real concern since asset prices have become exceptionally inflated relative to income in recent years, as shown in the following chart, which shows household net worth as a percentage of disposable personal income. In other words, wealth to income. The average for the wealth to income ratio going back to 1951 has been 576%. At the end of 2024, it was 783%. That was 36% above its long-term average.